Good afternoon, everyone. I am Rebekah Harding. I'm going to be talking through the Coriolis forecast for 2020 shortly. But first of all, I'd like to hand over to Sean Edwards, who is the chairman of the ITFA, for a quick introduction. Sean.
Thank you, Rebekah, and thank you to all of you on the line for joining us today in what's our first webinar. And the fact that you are joining, I hope some of you from the Americas, is a reflection of our expansion. Very recently, as you know, we have merged with the ITFA, and in other parts of the world, our membership continues to grow. Hence, we had this is the second of these webinars today. We had one for our European members this morning. Although the number of events that we are holding, physical events, is growing, we see the need for these kind of virtual meetings because of the widespread of the nearly 300 members of the ITFA. And I'm very, very pleased that we've got to inaugurate what will be, I hope, an increasing number of webinars. Rebekah Harding, who is the author of Weaponizing Trade, or the Weaponization of Trade, which is a phrase now that's passed into the lexicon, but which she coined back in 2017. And more recently, Gaming Trade, about the ways in which trade increasingly is being used as a tool of political and military, in fact, strategy. Trade itself and trade finance in 2019 sort of barely had its head above water. 2020, we see threats from new areas, which Rebekah is eminently qualified to talk about, from more compliance, sanctions, very interestingly, technology, which is a big challenge for many banks, is an area that we'll be talking about in some detail, and it's an area in which we feel that actually there could be a standoff here between banks and big tech companies who will be looking to utilize the data that banks possess, and which they haven't really exploited fully to date. That will be a very interesting aspect, I think, of what Rebekah is going to talk about. To be a little bit more optimistic, sustainable trade, green trade is seeing an uptick, and there are a lot of big programs. A lot of the development banks are helping with certification and putting a structure around this. But increasingly, banks are also beginning to fund in these areas, and there is a very interesting interplay there between banks and fintechs, some very small fintechs doing some really quite great things. So with that, again, my thanks for being on this call. I'll hand back to Dr. Harding. Thank you.
Thank you very much indeed, Sean. And I'd just like to say a couple of housekeeping things before I move into full presentation mode. The first is that we are recording this session, so we will be putting out a podcast of it. If you are uncomfortable with any aspect of this being recorded, do please tell us, but nobody is attributable by name. And the second point is that we're running questions and answers through the Q&A button at the bottom of your screens. You can keep your Q&A anonymous. Those will be fed through to us for answering at the end of the presentation. So without further ado, I would like to move into my full presentation, and if you'll bear with me a second, I will just be moving on to my slide deck. Thank you. And I will just be sharing my screen. So thank you to Sean, thank you to everybody for participating in this conference. My name is Rebekah Harding. I'm the Chief Executive of Coriolis Technologies, and as Sean said, I'm also the author of a book called The Weaponization of Trade, which in 2017 argued that the world of trade was being transformed by a new belligerent language that was being used by politicians, and trade increasingly was being used as a tool, as a mechanism for creating coercive influence around the world. We looked at policies, we looked at how the structures of trade were changing, and we argued that if trade carried on along this route, and if politics carried on along this route, the likely outcome of was a full-blown trade war and the breakdown of multilateral organisations. Unfortunately, 2.5 years on, we have to say that we're seeing threats to multilateral organisations, and our projection for 2020 is built on a 2019 state of affairs where the world of uncertainty seemed to dominate trade. During 2019, we had tensions between the United States and China. We had tensions between the EU and the UK around Brexit. And the result was, and obviously as well, political tensions around Iran and US, and tensions in the Middle East. All of this created a situation where the investment climate was uncertain, and this had a profound impact on the rate at which trade was growing through the year across the world. What we're seeing in 2020, and I'll talk about the numbers shortly, is a slight uptick in the value of world trade. But the actual underlying status of world trade is that we're predicting that it's going to remain relatively static. There will be a little bit of a, if you like, peace dividend, since rhetoric seems to have abated a little bit. And maybe some of that is also the relief of Brexit and the relief of the phase 1 deal. But there are storm clouds on the horizon. Things don't look that rosy, but having said that, there are opportunities in technology, there are opportunities in environmental trade, and we'll look at some of those as well. During 2020, we think that the trade war will shift from tariffs to sanctions, finance, and technology. Why are we predicting this? If you look at the phase 1 deal, and I will talk about this in more detail shortly, if you look at the phase 1 deal that was drawn up on the 15th of January and agreed on the 15th of January, we saw a limited range of agreements around tariffs in and for themselves. But what was important about that agreement was what wasn't in it rather than what was in it. And immediately around that agreement, the United States Commerce Department and the World Trade Organization, the United States and the EU and Japan started to look at other mechanisms for limiting the power of China. So we're predicting that during the course of this year, because of increased tensions still in the Middle East, and because of the fact that the phase 1 deal will not shift into agreement of a phase 2 deal until after the US elections, we're predicting that sanctions and restrictions on trade will continue to dominate the trade landscape. As I said, we're predicting trade growth itself will remain at near zero globally in real terms, although we are predicting a pickup above trend in, for example, oil prices and in some regions of the world. One of those regions is the ASEAN region. So that region in particular is going to benefit from the fallout of the trade war. We've seen a reallocation of trade from China to the ASEAN region. China has been exporting its supply chains for a long while now, but that's beginning to take hold. ASEAN itself is increasingly exporting outside, outside of the region, to China, to the US, and to South Korea, but also interestingly to Germany, where medical equipment is a very important factor as well. So it's in high tech as well as in intermediate tech sectors. We're also expecting intra-African trade to grow very rapidly, but actually in terms of the story of trade, it's the EU 27 where intra and extra European regional trade will grow without the UK. We're expecting as well oil prices to increase above trend during the course of the year. The reason why we're confident about our forecast there is because of the very high correlation between oil prices and the value of trade. So just to summarise, these are the highlights from what we've found and what we're saying so far this year. In essence, trade is going to be relatively static, but there are opportunities for trade finance continuing the trend of last year, which is moving around within regions rather than extra-regional or bilateral. So 2020 is looking like the game. The US-China Phase 1 deal is not the end of tensions, and I think there's a general agreement across commentaries and across the industry that Phase 1 deal was interesting for what it didn't say and not for what it did say. It talked a lot about agreements. We've already seen China come up with a reduction in its tariffs, partly because of coronavirus, partly because it had already agreed to reduce some of its tariffs as part of this deal. But US-China relations at the moment are so much more than simply trade. They are also about technology, the tensions around technology. They're also about this decoupling that we're talking about of technology and financial systems. All of this leads us to conclude that 2020 will be the year in which trade as a proxy for the struggle between the US and China, and arguably Russia as well, and I'll talk about that a bit later on. That struggle is going to come to a head. It won't be in terms of a major trade war, because we're running into a general election, in a presidential election in the US. But we will see increased rhetorical tensions, and we will see increased sanctions and restrictions on doing business in certain regions and with certain companies. Trade is being used because we're all familiar with trade. We all know what trade is as a concept. We all know about tariffs and duties as a weapon of trade policy. We understand that language. What's happening is trade is now being used to cover for a bigger conflict, and it's a conflict between the United States, China, and Russia around control of the digital space. It's almost like control of a new paradigm, the Internet of Things. So trade is being used strategically by nations. In other words, it's part of a strategic game being used by nations to create power and influence, and also modify behaviours of others. There are quite severe consequences for banks within all of this. So we would argue that this year the things to watch out for are more frequent and less predictable changes in sanctions regimes. Now, we started to see some of that last year with Iran. That started to have implications for the way in which messaging services were operating, particularly SWIFT. But these unpredictable changes means that compliance is still going to be the order of the game during the course of 2020. It means that there's also a higher risk of secondary sanctions. And this links to the issue of supply chain and supply chain transparency, because as we see more in terms of freight and in terms of logistics becoming interwoven with finance in smaller transactions and inventory management, we're likely to see the greater premium on supply chain transparency. So technology and trade finance, be it managing smaller arrangements over smaller periods of time, linking finance with inventory management and logistics, all of that places a premium on where goods are going to, where they are coming from, and understanding your transaction as well as understanding your client. So this whole risk of secondary sanctions, whether or not it's touching technology, whether it's touching Chinese companies, whether it's going into China, this is all likely to become more accentuated during the course of this year. And of course, we've already seen the threats to the messaging systems like SWIFT from the decoupling. We've seen a rise in the activity between Russia and China in terms of alternative messaging systems. And our core theme for the year in Coriolis Technologies, but our core prediction is that the role of banks is going to change dramatically. Unfortunately, the compliance function and the digital function has become incredibly important in banks. Trade finance has become incredibly important because we're seeing this conflict playing out through trade rather than boots on the ground. We're arguing that it's actually banks on the ground. If I move on now to look at world trade growth and how we think that world trade growth is going to grow during the course of the year. We think that world trade growth will be sluggish. Now, 3.7% growth in value terms seems like quite a lot until you look at the predicted rate of inflation during the course of the year that the IMF is predicting, which is about 3.5%. So in real terms, the value of trade is barely going to change at all. The volumes of trade are barely going to change at all. This makes us markedly more pessimistic than the World Trade Organization, but I would just like to flag here that Coriolis Technologies has always been more pessimistic than the World Trade Organization. In various iterations of the model that we use, we have always taken a momentum trade over a longer period of time. We've always used momentum forecasting rather than assumptions about GDP. So we're not prone to the same alterations in GDP, the same short-term fluctuations in GDP. The World Trade Organization is forecasting volume growth of about 1.4% this year and 1.2% last year. Our forecast suggests that last year was probably negative and this year is at zero. The reason why we're predicting like this is because trade didn't accelerate in October and November last year as much as it normally does. So we didn't see a premium from the build up towards Christmas and Chinese New Year. The coronavirus is already affecting trade flows. So we've already seen some impact on trade during the month of January, where we wouldn't have expected to see such a heavy impact in and around the Chinese New Year. It's usually a moment for greater consumer demand and festivities and more travel, and that is having a dampening effect on the global economy. Some economists are estimating that it will have a 0.2% effect on global GDP. We're expecting the tensions between the US and China to be less obvious, but as I said already, we're not expecting them to have gone away completely. And uncertainty around the UK-EU relationship will also remain. So there are still uncertainties, and as we'll come on to it later in the presentation, but we're seeing a reallocation within Europe of supply chains, and we're seeing that happen since the Brexit vote. So in actual fact, intra-European EU27 trade is increasing as a result of what we think is that relocation of supply chains. If I just look through each of these regions, this is their extra-regional trade. So South America and Sub-Saharan Africa and Middle East and North Africa, we're all seeing in those countries where there's a strong oil exporting bias, we're seeing exports grow relatively well and faster than imports. The EU27, this actually augurs quite well for EU economic performance this year. Imports are growing slightly faster than exports, suggesting that the European economy is actually stronger than it's currently looking like it is at the moment. Asia Pacific as well, we're seeing strong growth in imports and projecting strong growth in imports during the course of this year, as well as fast export growth as well. Again, suggesting that the Asia Pacific region is going to experience something of an uptick this year. North America, slightly slower imports and more rapid exports, which again, in terms of the Make America Great campaign, is positive news. If we look at some of the countries, the top 5 countries in trade export terms, plus the UK, The UK isn't in the top 5 in export terms. It's about number 10 in terms of exports, but it's interesting because of the context of Brexit. China, the US and the UK are projected to have stronger growth in 2020 than they had in 2018-19. So you can see this quite clearly, and I would argue this is to some extent what I'm calling the peace dividend or the fragile truce dividend. UK trade growth has been negative during 2018-19, and we're predicting that it will begin to grow again in the coming year. China is similar. We're expecting some kind of a pickup, and we're expecting a pickup in exports in the US as well. These are above trend growth, particularly in Chinese exports. It's above the world average. And so that augurs well for the export performance of the countries that have been particularly affected by conflict and uncertainty. However, exports in all countries, top 5 countries and the UK as well, are projected to fall back again in 2020-21. Now, we think the reason for that is because we're seeing a bit of a relief this year. We're seeing an effect of a calming down of the rhetoric, a phase 1 deal, Brexit is done, and so the trade relief, if you like, factor is coming in during the course of this year, but we're not expecting it to last. So we're expecting it to drop off quite sharply next year. And what this suggests is that there are still broader uncertainties in the trade environment which haven't gone away and which will start to manifest themselves again as things bed down after the shift this year. The result of this bilateral slowdown, if you like, is greater intra-regional trade, especially in emerging economies, but as I've said, apparently slowing bilateral trade. Similarly, on the import side, it doesn't look great from the perspective of global GDP growth over the next couple of years. Again, we may see a slight uptick in growth in some countries this year, USA, China, and potentially the UK as well. And Japan is an interesting one because we're looking at imports which are slightly higher there as well. Now, that might well be because we're expecting oil prices to be slightly higher this year. One of Japan's major imports is mineral fuels. Post Fukushima, that's been one of the major dependencies that's crept into Japanese imports. And it might be that that is simply a reflection of the fact that we're projecting higher oil prices as well. But again, the pattern continues, import growth slowing, reinforces the view of intra-regional trade being dominant, but it also reinforces the view that, that the IMF has, which is that we still aren't out of the economic woods yet. We're still likely to see some kind of a slowing down over the next 18 months, 2 years, projecting 1.4, 1.3% growth, which is still relatively sluggish. So if I take a look at this intra-regional story now, you can see quite clearly South America, Africa and the Middle East and North Africa in terms of their intra-regional trade, but actually their extra-regional trade as well. Over the last 5 years, so we're looking at a period 13 to 18 here, and then projecting forward to 2023 and an annualized growth rate. South America and Africa and the Middle East have all, over the last 5 years, suffered very badly from weak oil prices, and it's had an impact on general economic growth in the regions. There have been governance changes in Africa, political crises in Latin America, and also governance challenges and political threats in Africa and the Middle East. So we're seeing over the next 4 years a relaxation of some of those tensions. Perhaps we're seeing a pickup of this intra-regional trend. Similarly, North America, we're seeing an uptick in intra-regional trade, perhaps as a result of the new US-Mexico-Canada agreement, but also potentially because the exclusion of China is fueling trade between America, Mexico, and Canada in particular. Asia Pacific exports and imports remain relatively the same at the similar levels. But what's interesting about Asia Pacific is that within that region, we're seeing very rapid growth with China. So the figure is that the ASEAN region, its exports to China are increasing over the next year at a rate of 9%. Now that's very, very high, way above average for the world this year. That is actually a real terms growth. Now, a lot of that reconfiguration of the ASEAN region has been because of trends that have been happening for a long time. But of course, because we've also seen the reconfiguration of supply chains as a knock-on effect from the trade war, that is beginning to have an impact as well. But I've been tantalizing you with this particular figure, which is the EU 27. It looks like it's relatively slow, and it looks like its exports and imports across the region are relatively similar. However, intra-regional trade growth between 2018 and 2019 is projected at nearly 9%. So in other words, in this last year, 18 to 19, we think that intra-regional trade will have grown by around 9%. Between 2017 and 2020, in other words, the measurable impact of the period since the Brexit vote has been growth in intra-regional trade of around 7%. We're expecting growth to slow after that. In other words, what we can say, because of this very rapid growth and then a slowing down, is that it's a reconfiguration of supply chains within the European Union, within the EU 27. A lot of that is coming from Germany. It's going to Romania, it's going to the Czech Republic, it's going to Poland as well. But there is a strengthening, particularly of trade in France and Germany. So this is interesting because it suggests that these trading blocks are becoming very important, both in trade finance terms. Trade finance has been moving around these areas, but also in economic power, soft power terms as well. Let's take a look at this now on a sectoral basis. We think that, that these are just the top 8 sector global trade growth patterns between 2018 and 2020. And we've just looked at the top eight sectors just in terms of their overall growth. Now, what's interesting about this, again, is that you can see several things. So the first is that we're predicting a mild pickup in oil and gas prices in 2020. You can see this in this column here. Last year was relatively weak growth. We're expecting much stronger growth, and this is above average in terms of the world trade, average trade growth. Why are we so confident about that? It's because there is a 93% correlation over time, and we've been backtesting this and running this model for about 7 years now. There's a 93% correlation between the value of world trade and the oil price. So where we predict an increase, there will be a similar type of increase in oil prices as well. All of that says that that might mean that there are increased tensions in the Middle East, which may push oil prices up a little bit. It may mean that the world economy is picking up slightly as well, and that there is perhaps more demand for oil. What we're also seeing alongside this, and again, it's a very useful indicator, is that we're not seeing a particularly substantial flight to safety. It is increasing. So there's a similar correlation between precious metal prices, particularly gold prices, and trade. And we have seen, and we are seeing, an increase over time in the growth of trade in these sectors. But it's not it's below trend. It's below global trend, so it's not significantly higher than the global increase in trade. So it suggests that although there are similar correlations and although there is a pickup, it's below the general level of inflation, so it's not substantial. So surprisingly, we're not seeing a flight to safety in terms of gold trade and precious metal trade. We can see as well within all of this that the automotive sector over the next few years, trade is projected to grow. This suggests that the traditional automotive sector is still experiencing some difficulties. But more interestingly, perhaps within that, electric car growth is was 17.3% between 2018 and 2019. Although the sector is only worth 10.2 billion US dollars globally, it's relatively small, but it is growing, and it is growing very, very fast. And that's one to watch because it's an exciting new environmental area. Now, if we have a look at this, there's no obvious environmental dividend in the data that we're seeing here. So if you look, plastics trade, for example, dropping off a little bit, we can see as well that some of the things like automotives, you could say, well, maybe that is an environmental dividend as well, particularly given what's happening with electric car growth. But the important thing here is that we are seeing a drop in aviation fuel. It doesn't fall into the top 8 sectors, but we are seeing a drop off in the amount of aviation fuel that's being traded, although it's very high in 1 or 2 countries. Ironically, Poland and France are 2 of them, perhaps suggesting that there are tax regimes around those 2 countries that support aviation fuel trade. We are seeing a drop off as well in some of the environmentally difficult sectors like used clothing and like ferrous metal waste as well. And those are also sectors where there's high levels of crime associated activity as well. So we are beginning to see 1 or 2 things in the data that we're picking up on. The final thing that I want to pull out of this is actually pharmaceuticals. Pharmaceuticals are interesting because we can see that the drop-off is not significant between 2020 and 2021. And we have to ask the reason why. A lot of that is because China itself is investing an awful lot in pharmaceutical trade. It's part of its Made in China 2025. We're expecting Chinese exports of pharmaceuticals to turn positive during the course of the next 2 years. But the other thing that's really important about this is it's actually being driven by the new pharmaceuticals. So by vaccines, by biopharmaceuticals, which has been the story of the last 5 or 6 years. That's been a sector that's been growing very rapidly within the whole gamut of pharmaceuticals trade. So again, that's one to watch. I couldn't resist calling this goodbye to all that and Brexit. I think it's fair to say that this year will be a year of strong trade negotiations, and we do have views on that. But let's have a look at some of the numbers first. The UK's share of world trade has dropped over the past 15 years from over 4% to 2.5%. Now, a lot of that is because of the rise of China and the rise of emerging economies like South Korea as well into the trade mix. It applies equally to Japan, it applies equally to Germany, it applies equally to the United States. So obviously there is an element of, well, this is a developed country that's becoming less important in the whole world of trade. But this is the sharpest drop of anywhere in the world. This is the sharpest decline over that period of time. And so it is something that UK policymakers in particular need to be aware of. UK trade is fragile, and although we are seeing service sector trade grow, it's still not at what we would call an escape velocity. The other thing about service sector trade, and this is something that the government is looking into statistically, is that when you look at what other countries, particularly Germany, France, Ireland, and the United States, say they're trading with the UK, rather than what the UK says it is trading with the rest of Europe or the United States. The size of our surplus and the rate of our growth is not as quick. So our projections on service sector trade growth in the UK are not as big as those projections that the UK government has, because we mirror our data. We look at the trade flow both ways. And this means that the vulnerability of UK services and UK service exports in particular is very obvious to us. So how do we go about solving that problem? Well, Europe continues to be a very clear focus for the UK's strategic trade. That's obvious. We can't suddenly lose what is effectively more than nearly 50% of our total trade, whether it's in goods and services, or goods or services rather. UK exports have dropped over the last 5 years at an annual rate of 1.8%. So an annualized rate of decline has been 1.8%. Now, some of that is because of mineral fuels being a major area. Some of it is about the impact of the Brexit vote. Some of it is about the reallocation of European supply chains as well. We expect that to have picked up by the end of 2020. As I said, there's a slight peace dividend here, but we aren't predicting that the United States. So by the end of 2020, we expect our annualized growth in exports trade to the US to have fallen back by 0.6% since 2017. So we can't look to the United States necessarily to create a solution to the broader problem that we have. Interestingly, UK exports to Germany have increased by 1.2% annually since 2017, but this is likely to turn negative during the course of this year and into next, again making this point about supply chains very, very clear. So will there be a deal? And this will be the million-dollar question that everybody will be wanting to have the answer to. Our view is that we think that there will be a minimal deal. If you look at the rhetoric that's coming out of the Johnson administration at the moment, it is about the right to have free trade deals and the right to have divergent regulations rather than the must-have divergent regulations, so the imperative to have them. So that's a very important distinction, actually. It's about, and watching the rhetoric during the course of this year is going to be very important. The government has already said, as a follow-through, that they won't diverge just for the sake of it. They have launched this public campaign to get the public to say where the rules could diverge usefully. Nevertheless, the EU is our major trading partner. It's in both of our interests to come out with some kind of an agreement. But don't forget the Trump playbook. This is about getting some kind of agreement over the line. The more complicated stuff is likely to go into subsequent negotiations. So watch for what's not being said rather than what is being said. Just finally, we are looking to the risks to our forecast, and a lot of them, unfortunately, are to the downside. Sean once said that I'm noted for starting off a presentation on a negative footing and then turning it positive through the commentary. Unfortunately, there are opportunities. Of course, there are opportunities for trade finance in all of this, but a lot of the risks at the moment are to the downside. I think, having said that, the US election will affect trade rhetoric, but it might actually be more on the upside than the downside. So there's more of a box ticking, right? There probably will be a deal between the EU and the US that's fairly limited. Again, it's a box ticking exercise for President Trump to make sure that he has delivered on all of his election promises that he made before he became president. So we're likely to see a dialed down rhetoric because the phase one deal has been agreed, but we're also likely to see these box ticking deals. We may see the World Trade Organization start to lay out some foundations for for state aid as well, because there is an agreement between the Japanese, European Union and the United States on that as well, to try and tighten up those rules. We are expecting increased tensions in the Middle East, especially in Iran, but we're expecting a full war to be avoided. So the tensions at the beginning of the year, in the phrase of our head of political risk and strategy, was to escalate to de-escalate. So it's actually bursting the boil of the conflict, if you like, showing intent, having a bit of a spat to show the limitations, test the limitations of appetite for a broader conflict. There isn't an appetite for broader conflict. But watch out for the role of Russia in all of this, because during the course of a year where we are seeing an election, Russia is behind the scenes. It has a very big role in Iran. We are beginning to see this in trade finance terms, because the exclusion of Iran from financial networks has meant that China and Russia have started to look closely at messaging systems as an alternative to SWIFT. So that's on the trade side, but on the political side, we're also beginning to see in our data the fact that the Russia interest in areas within the Baltic, but also Serbia, Montenegro and Bulgaria are areas of interest. We're beginning to see Russian interest around those areas beginning to become more intense, and we're beginning to see one or two things in our data around Russia's increased interest during the course of this year in those regions. As I said, Brexit uncertainty has not gone away. Although, as I said, it's straight out of the Trump playbook. We do think that there may be some kind of a deal, simply because it's in everyone's interest to get this over the line, a no-deal exit. What's now being called the Australia-EU model is not in anyone's interest, because so much of European trade, including geographical European trade, so including the UK, is captured in agreements that currently exist. I would also argue that the US-China Phase 1 deal is a stalemate at the moment. It's a stalemate in the current game. The real work, as I said, has shifted to the technology space and control over the technologies and how they are used to create economic advantage. We're seeing a war that is becoming much more driven around economic and technological frameworks than anything in our history so far, and that's beginning to impact the financial space as well. So these are things geopolitically that we're going to be watching that may impact our forecast. Just to conclude then, here are our key things for 2020. And do join us and find out more about all of these things. We're going to be monitoring this strategic trade. It's become our big theme of the year. We're monitoring trade in dual-use goods and shifts in national strategy throughout the year to assess significant changes, so that we can start to look at where there may be future conflicts arising because of actually the trade that's happening between countries. We're going to produce a UK national security strategy, of which trade will be a very significant part, in the similar way to the US national security strategy of 2017. And watch out for our Future of Strategic Studies event later in the year, the 21st of October, because during that event, we will be bringing global economic experts and global strategy, national strategy and intelligence experts together in a framework to talk about trade. So watch this space. We will be giving more information of that out shortly. We think that environmental supply chains are the single most important thing to be looking out for from a research point of view, but also from a business point of view. We think the regulations around this are going to tighten up. We've seen the regulations for the IMO tighten, and we're beginning to see these types of environmental considerations coming into bank stress testing. So we're going to be creating indicators of trade, environmental added. We're going to be looking at environmental indicators in our trade data, and our first outing of that research will be in April 2020. Finally, we're also looking at digital trade and data. We're looking to develop digital trade data sets so that we can work with the likes of the OECD, but also the banking community to understand more about how digital trade is transferring across borders. And we very much like the participation of ITFA and ITFA members in that work. We will be producing a report on it later in the year. And we're looking to partner with some leading global research organisations as well. I'd just say, do check out our website. We will be in communication about all of our multilateral thinking programme, which is the ideas and the research that we do in trade. But do also contact us if you'd like a view of our platform, because we have a platform behind all of the information that I've said that produces the data and produces the views that I've expressed today. So it's all available on a technology platform as well. So we are a fintech business, and do let us know if you'd like to know more. It leaves me only to say thank you very much. The future of trade is data. Don't get left behind. Thank you very much for listening. And if there are any questions, I'd be very delighted to take